Welcome back to Investing Talk Podcast.
Today we're looking at the United States Oil Fund.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so let's just unpack this for everyone.
Right.
When we talk about this product, we're talking about an ETF that's designed to give you exposure to West Texas Intermediate Crude Oil, WTI.
Mm-hmm. But it's not like the fund actually owns, a tanker full of crude.
Right, no physical barrels. It tracks the WTI Cushing spot price.
Exactly. And it does that using futures contracts. That structure is, it's absolutely fundamental to understanding everything about it, the risk, the reward, all of it.
And that structure is also its biggest advantage, its competitive edge.
It is. Surprisingly, yes. This was the original oil exchange traded product. It launched way back in 2006.
Wow, that's some serious longevity in the ETF space.
It is. And that history, that structural design, it's given it this massive inertia.
Okay, so when you say structural design, what does that mean for an average investor? What are the actual benefits? Because dealing with physical oil sounds like a complete nightmare.
Oh, it is a logistical nightmare. So this offers pure play WTI exposure. If you want to bet on the U.S. oil benchmark, this is pretty much the most efficient way to do it.
Without having to manage complex derivatives yourself.
Or worse, worrying about storing physical barrels of oil. And maybe more importantly, you get superior liquidity. You can trade it intraday on NYSE Arca.
And liquidity is it's crucial here. In a market this volatile, being able to get in and out fast, that can make or break a trade.
Precisely. That's what protects its market share. It's also, pretty precise in its tracking, at least in the short term.
How precise are we talking?
Well, the goal is to track the WTI spot price within about plus or minus 10%.
Over what kind of period?
Over any given 30-day period. So that precision, the easy access, and its huge market size, that's what keeps it dominant.
Okay, that makes sense for the structure. It's the main access point. But you mentioned volatility, and we have to talk about the elephant in the room, the recent headlines.
Right.
How healthy is this product, really, especially with oil's recent performance?
This is where you have to remember it's a fund, not a normal company. We saw a reported net loss of $32.96 million for November 2025.
Almost $33 million.
Yeah.
In 1 month. To most people, that sounds catastrophic.
It sounds terrible, but it was tied directly to unrealized losses on its futures and swaps.
Unrealized. So when the price of oil fell, the value of the contracts the fund was holding just went down on paper.
Exactly.
Yep.
The net asset value, the NAV, dropped from about $960 million to $925 million.
Okay, so hold on. The fund didn't spend $33 million. Its assets just lost that much value because the commodity it tracks fell. Is that normal?
It's completely normal. It's expected even. Its financials are entirely driven by the price of oil. If oil drops, it reports a loss.
And if oil skyrockets,
it reports a huge unrealized gain. The previous month, October, showed much stronger performance. Its health is tied to the cycle, not its operations.
That's a huge distinction. So we're looking for structural health, not operational profit margins. What does the actual balance sheet look like then?
It's exceptionally clean. This fund has no traditional long-term debt.
None.
Zero. All of its assets are collateralized. They're backed by cash equivalents, and short-term U.S. government obligations.
Okay, so we're talking about things with maturities of 2 years or less.
That's right. And that structural stability, that's the real anchor, isn't it? That collateral means the fund can always meet its obligations.
Especially when it's rolling those futures contracts.
Precisely. And they also provide daily NAV disclosures, which definitely helps investor confidence during these sharp price swings we've been seeing.
So let's talk about one metric that can be confusing here.
Yeah.
The PE ratio. It's listed at 11.71. Why does an oil fund even have a PE?
That's a great question. The E, in this case, the earnings, it's not from selling a product. It's mostly from the interest income on that government debt we just talked about.
A debt that's used as collateral.
Exactly. So that PE of around 11.7 tells us that even with that scary $33 million headline loss, the market sees the price as pretty stable relative to that underlying income.
So the market has already sort of priced in the oil volatility. It's not a systemic issue, just market noise.
It's a function of the oil price cycle, not a failure of the fund itself. And speaking of cycles, let's pivot. The bull case here is, it's incredibly compelling right now.
Okay, let's get into it. Where are we from a technical standpoint?
Well, the fund's been consolidating. It's hovering near multi-year lows, right in that $68 to $70 band.
So it's building a base.
It looks like it.
Yeah.
And the key level to watch is that $68 support. If the price holds there, a lot of analysts see that as a really strong entry point.
Assuming WTI itself rebounds.
Of course. The first hurdle we'd need to clear is around $72.
Technicals are one thing, but what is the options flow telling us? Where is the so-called smart money moving?
This is maybe the loudest signal we have. Options traders are stacking up enormous bullish bets.
How enormous?
On December 24th, over 65% of all options trades were calls. Bets that the price will go up. And the open interest is huge, meaning people are holding these positions.
So it's not just quick day trades.
No, we're talking about hundreds of thousands of contracts outstanding. This isn't just general bullishness. When you see this much volume favoring calls with this much open interest.
That's what you'd call whale accumulation.
Exactly. It indicates large institutional players are positioning for an imminent spike. It's a hidden bullish divergence. The price is flat, but the big money is betting on a violent reversal.
And they're betting on a specific catalyst. Let's talk about the situation in Venezuela.
This is the primary driver. Speculative markets right now are pricing in a greater than 50% chance of a major U.S.-Venezuela conflict or escalation by March 2026.
Why March 2026 specifically? And why is Venezuela so important?
The timing relates to some internal political flashpoints there. And Venezuela matters because it holds the world's largest proven oil reserves.
The largest.
So any conflict, or even just the threat of a supply disruption, would immediately take a huge amount of potential supply off the global market.
A supply shock.
A massive supply shock. It would spike oil prices dramatically, and of course the fund's NAV would soar right along with it.
So this isn't just about demand slowly recovering. This is a bet on a high-impact, immediate event.
It is. And there are other factors tightening the coil, too. We have a tightening global supply balance in general. OPEC has shown it's willing to cut production.
Especially when WTI is testing these lows.
Exactly. And then you have the domestic political situation. Energy often sees rotation as an inflation hedge. And while some policies aim to boost U.S. output long-term,
The short-term uncertainty could actually tighten the global market.
right, it could encourage OPEC to keep the taps tight. It
Yeah.
all points to a constrained supply future.
So you've got the technicians saying, buy the dip, the options traders screaming upside, and geopolitics providing the fuse. Now we have to flip the coin. What's the big risk here?
The big one. We have to talk about contango erosion.
Okay, let's slow down here. This is probably the single most important concept for anyone looking at this product.
Absolutely. So contango is when the price of oil futures for delivery in the future is higher than the current or front month price.
Which is most of the time.
Almost always. Now, to track the price, the fund has to constantly sell its expiring front month contract and buy the next month's contract.
Which is more expensive.
Exactly. So you are perpetually selling low and buying high.
Even if the actual spot price of oil is just staying flat.
Right. It's like trying to run up a downward moving escalator. You have to run pretty fast just to stay in the same place. Over time, this roll drag can significantly eat into your returns.
So you have this product that's great for short-term access, but it's structurally designed to bleed value over the long term. That's the conflict.
That is the ultimate caveat. And on top of that, you still have the general risk of oil price volatility. That $33 million loss in November is a stark reminder.
And robust U.S. shale production is still a factor, right? Kind of puts a cap on how high prices can go.
It's a powerful governor on the market, absolutely.
So with this huge structural drag, how are these institutional players justifying these massive bullish bets?
They see these risks as being priced in at the current levels. Everyone knows about contango. But for a trade targeting Q1 2026, the liquidity and, more importantly, the massive immediate upside from a geopolitical event.
They see that as outweighing the slow, predictable bleed from the futures roll.
Exactly. It becomes a high-stakes bet on volatility.
So if we're looking at a swing trade into Q1 2026, what's the roadmap? What date should we be watching?
Okay, 3 key things for your calendar. First, the 5-day futures roll. That starts January 1st, 2026.
What should we be looking for there?
We'll see how the fund executes that roll and how steep the contango is. It'll get us an early clue about market sentiment for the quarter.
Okay, what's next?
Second, the next monthly account statements, they'll be out in early February. Consensus is expecting a NAV rebound based on the oil uptick we've seen since those November lows. A strong report will add fuel to the fire.
And then the main event.
The main event. The peak for Venezuela tensions is anticipated around March 2026. That's the window the options market is targeting for a potential supply shock to hit.
So if that geopolitical risk materializes, what's the upside potential analysts are talking about?
We could see a potential rebound of 20% or more.
Which would push the price right back toward that critical $72 resistance level.
That's the target. The whole thesis is that the huge, immediate geopolitical positive can temporarily overwhelm the long-term structural negative.
That is fascinating. You're betting that the threat of a violent immediate supply shock is strong enough to overcome the slow, steady bleed of contango.
It really gets to the core of trading energy. You're not just betting on economics, you're making a calculated bet on global instability.
It's a pure play on volatility itself. So the decision for you, the listener, becomes, do you focus on the clean balance sheet and the structural drag, or do you take that leap on the March 2026 odds?
A classic high-risk, high-reward scenario.
Absolutely. For more detailed market breakdowns like this one, where we weigh the deep structural risks against massive potential catalysts, make sure you subscribe to the show. We'll see you next time.